Good morning, Accounting 201 students. We're going to pick up where we left off on Tuesday. We had reviewed the big accounting model, assets equal liabilities plus stockholders' equity. I've abbreviated here. This is what I put on the board on Tuesday, and how revenue causes retained earnings to go up, expense and dividends cause it to go down. And let's just review. Now we have added to that in Chapter 3 the idea of debits and credits. Debits have to equal credits, and the abbreviation for debit, for whatever reason, is DR. The abbreviation for credit is CR. And so we know that we don't actually process accounting transactions doing this. That is part of the thought process, but we actually do it this way. We know that when this side goes up, that this side also has to go up. And 500 years ago, the Italian monk that came up with these two equations just said, let's assign this increase over here, let's call that a debit, and this increase over here, let's call it a credit. So this side always equals this side, and debits will always equal credits. And then he flipped it. If one side goes down, the other side goes down. He flipped the debit credit rules. That's what they are, that you need to memorize these debit credit rules. So assets go up with debits. If I want to decrease an asset, I will credit. We will not actually use negative numbers. Instead, we use these debit credit rules. And also we went through and said, debits are always on the left, credits are on the right for each account. So we have these T accounts and we put debit, credit, debit, credit, debit, credit, debit, credit, debit, credit. Debits are always on the left, credits are on the right. Just a little help you remember, it's corny, but the idea of Washington, D.C., debits left, credits right, to help you remember that. Okay, so just a refresher on the debit credit rules. Okay, so let's go to our problem. We got all the way through number 10, and let's just work our way through. Ideally, you would stop this video and work 11 through 14 on your own. That's how I'd really prefer you do this, but I'm going to quickly go through them just so you have the answer. So receive cash for services to be performed in the future. Recall we've already done this problem in Chapter 2. We're just adding debits and credits. So cash would have come in, which is an asset. We haven't performed the services. We have a liability, unearned revenue. I'm going to abbreviate revenue, REV. So cash, which is an asset, will go up. Liabilities, unearned revenue will go up. Assets go up with debits. Liabilities go up with credits. And assign your debit and credit. You're going to debit cash and you're going to credit unearned revenue. Now go take this to your journal and record debit cash, credit unearned revenue. 12, pay cash in advance for a 1-year lease to rent office space. I'm going to skip over here and do it here. So cash would have been paid. That's going down. And for a 1-year lease, if we haven't used something, that's an asset. So prepaid rent is the name of that account. And both of those are assets. And nothing happened on the other side of the accounting equation. Cash went down in exchange for a prepaid rent. And then reviewing our debit and credit rules, cash went down, so it's going to be the credit. Prepaid rent went up, it will be the debit. So assigning your debit and credit, we're going to debit prepaid rent and credit cash. Then you go, once you have figured this out, you go over to your journal and you'll record. You're going to debit prepaid rent and credit cash. May 7, purchase supplies on account. So supplies will go up. That's an asset. So supplies will go up. So supplies come in and we're buying on account, so we're not paying it. So accounts payable will go up. Let's just abbreviate account payable. and account payable is a liability. So an asset is going up and a liability is going up. Just a quick review over here. Assets go up with debits. The liability account payable goes up with a credit. So assign supplies will be our debit, and we will credit accounts payable. So you'll go to your journal, debit supplies, credit accounts payable. And the last one, pay $200 toward the purchase of supplies. So we're going to pay cash, so cash will go out, which is an asset. Now, we're not using the supplies. Nothing has happened to, right, the paper and pencil and all that we're using. We're paying cash on this account payable. So the purchase of supplies, we bought it on account, so that account payable is going to go down. We're making payment on that. And that's a liability. So assets are going to go down, liabilities will go down. Again, nothing happens to supplies. We're paying on the account, the original purchase. So that does, we're not using the supplies yet. Okay, so cash will go down, that's our credit. Liabilities go down with a debit. So we're going to credit cash and debit accounts payable. Okay? All right, that has figured out all the journal entries, and let's go all the way through. I've gone ahead and I'm just going to show you screens. Remember, I had these in different order. For the actual problem, I had grouped them according to categories like cash payments or accrued items or deferred items. Here, I have the dates, and we were entering them in by date. So we've done January 1 and March 5th together in class. Notice, remember, the check marks means we posted it. So just a refresher, debits go first, and then we indent to the right, credits go next. So you are welcome. I will scroll through this real quick, and you can check your debits and credits. Just pause where you might need to on the screen as I go through this. And then the next page will look like this. Okay, and that gets us all the way through the regular journal entries. Now, I wanted to make sure before we post it in class that you have all of that correct in your journal. So this is the general journal. This is what tells us what happened to the accounts. By the way, you're going to have a homework problem where you're going to see these journal entries and you have to describe what happened. So if, for instance, January 1, if cash went up and common stock went up, well, you have to think backwards. What was that transaction? Well, that's because they issued stock. February 3rd, if cash went up and unearned revenue, I put that in the wrong direction, didn't I? Unearned revenue went up, which is a liability. So if cash went up and unearned revenue went up, liabilities went up. We owe services, so we have received cash from the customer and we owe them services. March 5th, cash came in, note payable went up, so we borrowed money, didn't we, from the bank. April 1, prepaid rent went up, cash went out, so we paid in advance for rent. So et cetera, et cetera. So I'll let you have fun doing those. Okay, here you can watch me, or you can just do this on your own and check it when we get to the ledger. But I'm going to go through and repost these. So cash goes up and unearned revenue. So I'm going to go post that, debit cash, credit unearned revenue. So let's see, that was, sorry, let me go back to that. February 3rd. So February 3rd, we had a debit to cash of $2,400. Remember, we started out with 0. And then we're going to go to unearned revenue. So let's go find liabilities. Unearned revenue. We credited it, so I'm going to put the date, February 3rd, and $2,400. So the date goes here. It's a liability. Liabilities go up with credits and down with debits. Same thing over here. Account payable is a liability. It goes up with credits and down with debits. Same thing here. Utilities payable. And all of these accounts would have beginning balance of 0. Remember, its normal balance is whatever causes it to go up. Land, on the other hand, is an asset. It goes up with debits and down with credits. So all these assets, let's remind ourselves, they go up with debits and down with credits. Up with debits and down with credits. And I'm just going to enter in 0 beginning balances. And let's do the next page. Let's just finish this out. So we already did note payable on common stock in class. Retained earnings goes up with credits and down with debits. Dividends, though, recall dividends. Let's go back to our debit credit rules real quick and review this. So dividends cause retained earnings to go down. So dividends are debits, so are expenses because they cause retained earnings to go down. But revenue causes it to go up, so revenues are credit amounts. Okay, let's get back over there and finish this. Okay, so dividends will go up with debits, but it will have the impact of reducing retained earnings. We're just not seeing it yet, but we will next week. Revenues go up with credits. Expenses go up with debits. So let's put all of those in. Okay, and so there we have. So we have all our expenses. Notice all our expenses go up with debits. And dividends go up with debit, but revenue goes up with credits because it causes retained earnings to go up. Common stock goes up with the credit and all our liabilities. Okay, let's go back to our journal. We've posted that. And then just keep posting. So prepaid rent is debited, cash is credited April 1. So April 1, prepaid rent is debited, $3,600, and cash is credited. And when I go to cash, I'm going to go to the very top and put that credit there. And when you're doing this in Connect, you'll have an ending balance will just pop up for you. Okay, and then just keep going along. And again, you may want to pause and then just do your own and not listen to me. I'm sure this is not the most riveting. Okay, debit supplies, credit accounts payable, May 7. So May 7, debit supplies, 500. And then accounts payable was the credit. So put it in the credit amount, and that was May 7. And then one more. Accounts receivable and service revenue. Debit accounts receivable, credit service revenue. So June 2, debit accounts receivable, 8,000. And then go over to revenue here and credited 8,000. And put in our date, June 2. Okay, I am going to end this and make this part 1 of the video. I'm going to go ahead and just post everything on my own, and then I'll start part 2 of the lecture.